Ladies and gentlemen, welcome back to the channel. We have some big news that is likely going to spark a year-end rally, probably into January also. As you know, if you've been a viewer of this channel, I was concerned about January. I said if we do see a year-end rally, it likely ends in January. We likely get a correction in January. But a lot has changed over the past even week or so, with pretty much all of your market sentiment measures that are now extremely negative. I think this actually sets you up very well for a year-end rally at this point and a strong January effect. Now, the January effect is general optimism in the first couple of weeks of January about the new year. Google says the January effect refers to the observed tendency for stock prices to rise more significantly in January compared to other months of the year, often attributed to investors buying back stocks they sold for tax loss harvesting in December, leading to a price increase in the new year. This phenomena is considered a seasonal anomaly in the financial market and is debated among financial experts regarding its reliability. And as you see here, historically, you kind of get that, what looks like a little dip into year end, and then January tends to be pretty strong. Now, this can happen on a single stock basis, or obviously this can happen on a broader market basis. Now, mix the January effect, the psychological aspect of that, with the fact that we just had a pretty aggressive sell-off, and most market indicators are sitting at extremely low levels. Like, for an example, 67% of our markets are currently in a downtrend. Only 33% of stocks are trading above their 50-day moving average. I mean, that's not a strong market. I don't know. I don't know about you guys, but 67% of stocks being in a downturn is not very strong. The Dow has been red for 3 weeks in a row. You had 10 down days for the Dow in a row. That was the worst since 1974. Okay, I don't think anyone had that in their bingo cards into year end. Well, it happened. On Thursday, CNN's Fear and Greed Index was in extreme fear territory at 22. It closed Friday at 28. Okay, so a little bit better, but still in the lower bounds of fear. Like, markets are nowhere close to as optimistic as they were previously. Should I mention the VIX that spiked to 28? It was up 75% in a single day, as Tom Lee said. Well, you've only seen that 5 other times in history, and every time that has happened, markets have been higher a month later, sometimes even just a couple of weeks later. Because when everyone gets so negative all at the same time, you have to see things continuously and progressively get worse for the markets to get worse, okay? And if it's maybe not as bad as feared, then things can start to recover. Now, I think a lot of next week's rally is probably going to be fueled by the government shutdown crisis that was just averted after President Biden signs the stopgap funding bill. This was actually approved late last night from the House and the Senate. And this is big because over 1 million government workers would all of a sudden not get paid, especially during the holiday season. That is not good. Now, the last time we had this fear of a potential government shutdown, the deadline was October 1st, 2023. And what happened after that was the markets did bounce a bit. Now, we ultimately fell lower because there were some other issues going on at this time, but simply the government shutdown being averted likely caused this bounce during this correction period that we were in 2023. Well, take that into context to where we are today. Yes, we just did see a 4% decline. Jerome Powell had a bad day or something. He didn't communicate the right way. So markets sharply reset lower. But now you've had some Fed officials like Austin Goolsbee come out and say, that we're going to hit our 2% target and the Fed's going to be cutting rates next year. Okay. And in all actuality, the Fed dot plot says we're going to get 2 rate cuts next year. But the markets kind of jumped to conclusion that inflation is going to be higher. The Fed's not going to be cutting rates. Maybe the Fed might even raise rates. And that's why the VIX abruptly shot up 75% on Wednesday. It's starting to become clear that that's probably not what Jerome Powell was trying to get at on Wednesday. Maybe it was just a miscommunication that Jerome Powell was alluding to. And now that you have funded the government for another 3 months, this likely paves the way for a strong December and likely a strong January. The fundamentals really did not change at all recently for markets, okay? From earnings expectations perspective, I mean, it's a little bit harder to justify the multiple, right? If we were expecting 4 cuts next year and now we're only expecting 2 cuts next year, okay? But I personally see that as an upside surprise throughout 2025 because I think inflation is going to come down more than expected. Now, not to mention PCE came in lower than expected as well on Friday. So that was also really good news. And that helped drive the RSP up 1.4% and another 0.15% higher in after hours. Now, another reason why I do think markets are going to move higher over the next couple of weeks is, again, the markets are very negative right now. 67% of stocks are currently in a downtrend. CNN's Fear and Greed Index is sitting at 28. Like, that's a very low level when not much has in actuality actually changed. Yes, Jerome Powell had a bad day. He miscommunicated a little bit. The dot plot's still pricing in 2 cuts. And it's just like the Fed is reverting back to data dependency. So the markets are going to be very focused on the data, okay? So that's maybe a little bit different, but is that a negative? Well, as long as the data doesn't come in bad, then it's not a negative, right? It could actually be positive. We could get more cuts than we're expecting in 2025. So longer term, that could be a positive. But now the government shutdown has been averted. So again, 1 million plus in government employees are not going to go without paychecks. That's really good for the velocity of money for the economy. I mean, 1 million people all of a sudden, up to 2 million people all of a sudden unemployed isn't great, okay? Or on unemployment is not great. Now, the other thing you have to consider is we don't have any earnings until at least the second week in January. But really, you don't get the banks until January 15th. You start off with Wells Fargo, Citi, JP Morgan, BNY, and the rest of that week, you really kick off the banks. So we don't have earnings until mid-January. As far as the economic calendar for next week, you really don't have anything as well. On Monday, you have Chicago Fed National Activity Index, CB Consumer Confidence, and that's it. Two-year bond auction, but that's not really important. On Tuesday, you have durable goods orders month over month. That can be important, but expectations are already really, really negative, right? Consensus expectation right now is negative 0.4%. Last month was 0.2% on a month over month basis. You get new home sales for November and new home sales month over month for November. Richmond Fed Manufacturing Index, manufacturing shipments, and Fed services revenues. But none of this data is super important. Durable goods orders is, but I'm assuming you probably come in on you probably beat that consensus estimate because it's so negative already. Wednesday, obviously, markets are going to be closed. That is Christmas. On Thursday, you don't have anything at all besides initial jobless claims, expecting that's going to fall to 218,000. Again, I don't know if good data is going to be good for markets at this point or if bad data is going to be good for markets at this point. So that's something I want to watch and see how the trend, kind of evolves. On Friday, you get the good trades balance, advanced data for November, retail inventories, wholesale inventories, S&P Case-Shiller home price month over month and year over year. But again, none of this data besides Tuesday's durable goods orders is really hard data. Okay, and I think durable goods orders is, again, going to come in a little bit better than expected. But if it comes in bad, I mean, that may be a positive for markets as well. We just really don't know at this point. So the lack of catalyst, seasonally, you tend to, have a Santa Claus rally. You just got super negative on markets, and there's a lot of room to get positive here. Crisis averted with the government shutdown. I mean, what's there not to like about the setup into year end and even into January? Now, if we do get too optimistic, if the rally gets too big, then obviously that sets you up for a little bit of disappointment sometime in Q1 2025. Like, things will disappoint at some point. I actually think we could get multiple corrections in 2025. I don't think it's going to be nearly to the same extent of 2024, just the market's going up in a straight line. But from where I sit right now, I mean, I'm not concerned about the markets into year end. Although things don't look great in some areas, the Dow does not look great. Value stocks are on their worst streak ever. Okay, which probably bounces back in January. I think a lot of that has to do with tax loss harvesting, right? The January effect could be profound in something like even the RSP, the equal weight S&P, right? I don't think you're going to see as much positivity in big tech because they're already trading at very high valuations. They're trading with a lot of, high expectations already. But like the RSP that's died in the last couple of weeks, that could see a nice bounce. The broader markets could see a really nice bounce over the next couple of weeks. Something even like a Tesla, right? Could see a very nice bounce after it's fallen almost 15% in just a couple of days. These are more or less the areas that I like. Okay. Longer term theme in 2025, I like the AI appliers, which number one is Tesla, but you could say other stocks are also there as well, like Elastic NV or even data center names like Applied Digital, right? Those are some of the names that I like for next year. Healthcare, honestly, not a bad area because it's just beaten down. Nobody likes healthcare right now. And if there is an upwards surprise next year to expectations, it might be in something like healthcare. It might be in value. Okay, that's where I want to position, not in your big tech names. So if you have a lot of big tech exposure and you don't necessarily want to be super exposed throughout all of 2025, if you do see a rally there, I think it'd be a great time to take a little bit off the top and to rebalance portfolios a little bit. You probably don't want to get out of it entirely, but a nice little rebalance, probably not a terrible idea. So with all of this said, ladies and gentlemen, let me know what you guys think about this down below in the comment section. Honestly, I wouldn't be surprised to hit new highs on markets, 610 to 615, maybe even 620 into the first 2 weeks or so of January. I mean, that is kind of what I'm expecting at this point. So let me know what you guys think about this down below in the comment section. Have a fantastic rest of your day, and I will see you in the next one.